Welcome to what we would all like to think could be one of the last virtual CLE events that we'll have to attend behind a computer screen. The Georgia Supreme Court has authorized Georgia attorneys to complete their 2021 CLE virtually, and today the Taxation Executive Committee has put together a timely and interesting program to help you get to your hourly goal. For this one day, we can forget about calls from clients asking about PPP loans, child tax credits, and that very popular question, where's my refund? I'm Jeff Cohen, Chair-elect of the Tax Section, and I'm joined today as co-moderator with Andy Yates, the outgoing Chair Section. Andy deserves a lot of credit for guiding the Executive Committee during a very different and challenging year. Your 2 CLE hours today will be paid for by the Tax Section, which is a nice gesture, and it will be automatically reported to the State Bar. And before we get started, and Andy's going to remind you about this, we will have our Tax Section annual meeting on August the 9th by call-in. Today's agenda will be a federal agenda, and we'll have 3 esteemed presenters. We'll have Cass Brewer, Professor of Tax at Georgia State University. We'll have George Abney, who's a partner at Alston & Bird. And as a special guest, we'll have Emily Yohn, Supervising Attorney at the Georgia State University Low Income Taxpayer Clinic. At the end of the program, your Q&A, you can ask questions and answers with your Q&A button at the bottom. At the end of the program, we'll try to reserve 10 to 15 minutes so the presenters can answer your questions. After the fact, this webinar will be recorded and you can see it and watch it again on the State Bar website. Andy?
Thank you, Jeff. I just wanted to say a brief hello to everyone. I learned right before the meeting that we have 167 people registered for this CLE, and that is excellent attendance. And I'm glad that a lot of members of the section were able to use this opportunity to get some CLE. I echo what Jeff said. I hope that this is the last time we have to gather this way, and the next time we gather for a CLE or social event, we can do it in person. I'm really looking forward to that. I want to give Jeff great thanks. He did the vast majority of the work to pull these speakers together and organize this event and gather this esteemed panel. So I want to give him my thanks for making this event happen. As he mentioned, we are going to have our annual meeting of the taxation section on August 9th at 1 o'clock. There will be an invitation going out to all the section meetings, section members today or tomorrow to announce that meeting. In addition to the business that we have there, which is electing the officers and going over the annual report and the finances of the section, all of which takes not a huge amount of time. We're also going to have a short presentation from a group of authors, members of the tax section, who have written an update article on state and local tax. So that will be a nice complement to this event. It won't be a CLE event, but if you have a few minutes on August 9th after the business, we hope that you'll stick around for that and learn a few things. But with that, I want to turn it back over to Jeff to introduce our panelists and get the CLE rolling. Thank you.
Thanks, Andy. Thank you very much. Our first presenter, I'm honored to say, is Professor Cass Brewer from Georgia State. And not only is Cass a well-known speaker at Southern Federal and various other institutions and seminars, but he is now named Associate Dean for Academic Affairs at Georgia State Law School, and congratulations to you, Cass. And welcome to the tax section of Georgia, 167 tax lawyers, waiting to hear what you say about recent federal tax developments.
Okay, thank you, Jeff. I'm going to assume everyone can hear me, correct? If you'd be saying something already if you can't. I am also going to assume that you can now view my screen. And if you don't see a big blue PowerPoint on your screen with my name and recent developments, someone please tell me, okay? Hearing nothing, I think it must be okay. Whoops, we don't want to do that. Leave the webinar. All right. So yes, I'm the new Associate Dean for Academic Affairs. So if any of you have advice on how you manage 60 to 70 employees with lifetime appointments who I can't demote or fire or reduce their pay, I would love to have your recommendations. You can wish me luck. this next year because I'm going to need it. Okay, so with that, let's move to the first slide. And what I try to do here, hopefully it'll work okay, is make a cross-reference to the outline with anything that we're discussing. And there's no way we're going to get through it all today. That would just be impossible. The outline is, I don't know, 80 plus pages or so. But hopefully the outline can serve as a bit of a starting point for you if you have an issue and you want to find out if there are any recent developments. Some of you also may have the ABA Tax Lawyer, which came out recently, has essentially the same article in it, except I have added a few items since the ABA article was published. So the first place I want to start is on item D2 on page 6. I did have to make a few corrections to some of the cross references this morning. So if you downloaded or otherwise received the PowerPoint, make sure you get this more recent one if you can, so that we can correct those cross references. If anything, I'm off maybe a page. That's it. But so we got 162F. 162F, as you all know, is the general deduction provision, ordinary and necessary expenses, but it also has a disallowance provision. And the disallowance was for fines or penalties. And that's the way the law read until the Tax Cuts and Jobs Act of 2017. And 2017 amended 162F to say that disallowed business deductions include any amount paid or incurred, whether by suit, agreement, or otherwise, to or at the direction of a government or governmental entity in relation to the violation of any law or the investigation or inquiry by such government or entity into the potential violation of any law. So suddenly we had this new language that arguably is much broader than the previous language, stating just fines or penalties. And there's really nothing in the legislative history that tells us the rationale. We do have now regulations. Regulations were issued on January 19th of this year. And the regulations provide further guidance and tell us that although the general rule is any type of fine or penalty, is disallowed, that the disallowance does not apply to amounts paid as restitution or amounts paid to come into compliance. And then to meet either of those exceptions, the taxpayer has to satisfy what is called the establishment requirement and the identification requirement. Essentially, what those requirements are all about is providing in the agreement or the judgment or the decree or whatever may be associated with the payment to the governmental entity, designating the amount paid as a restitution or as a payment made to come into compliance with the law, not some other type of payment that could be a fine or penalty. And the regulations give us a number of examples. I would say the uptake on this one is if you are representing clients who are in a situation where they've been threatened with a fine or penalty to be paid to the government, or perhaps having to make payments to come into compliance with law. I think about the notices that our clients get from the Secretary of State to file their annual registration. And if you don't do it by, I believe it's May 15, maybe May 31, then you have to pay an additional $15 or so. And I'm pretty sure that's denoted on the form as a penalty, but it seems to me that is a payment to come into compliance. So the deduction is not disallowed for that type of payment. I would, again, you need to read the examples, but I want to highlight one example in particular And it's example 8 of the regulations. It's at the bottom of page 7 of your materials. And I'll summarize. I don't want to just simply read the example, but basically you had someone contracting with a governmental entity, and it was about designing and build a rail project. And in a change order, the taxpayer requested an additional $50,000 from the governmental entity to cover unexpected costs. Later, it was determined that the taxpayer had not disclosed that those costs actually could have been known at the time the taxpayer entered into the contract with the governmental entity. And so the governmental entity sues the taxpayer under the False Claims Act, and the court holds that the taxpayer must restore the $50,000, okay, pay it back, the additional amount charged, $50,000 paid back. That amount the taxpayer could deduct. But the court also imposed $150,000 in treble damages under the False Claims Act. Again, this is an example from the regs, and the example holds that that amount, the 150, is not deductible. So again, the takeaway for us as lawyers, I think, is understanding, particularly if you have the opportunity to have a settlement agreement with the government, understanding the effect of how the payments are designated in the settlement agreement will matter in terms of the client's ability to take a deduction. Next item I want to talk about is something some of you may have heard of, and generally this may not be anything that we as tax lawyers worry about too much, except to the extent we incur these expenses in our own firms or in the practice of law. So we have the Tax Cuts and Jobs Act back in 2017. It disallowed a business deduction for entertainment costs with respect to an activity. It's the type generally considered to constitute entertainment, amusement, or recreation. It also disallowed deductions from membership dues with respect to clubs organized for social purposes. And this would not apply to your ABA dues, by the way. So it applies to taxable years beginning after 2017. This notice tells us that notwithstanding this entertainment rule, meals, your payment for meals are separate. All right. So you may take a client out to a really, really nice dinner at a restaurant, and perhaps it's even a piano bar, right, with live music. But if you're paying for the meal and not any other payment for the entertainment, it's still deductible. Okay. And I'm sorry, my slide advanced on me when I didn't want it to. Apologies. So, okay, that is all well and good. And in my slides, I'm going to go over this fairly quickly. There are some examples. These are taken from the regulations, and they rehash the rules. It can't be a lavish or extravagant meal. You or representative from your firm has to be at the meal with the client or prospective client. Those are rules that have been around for a while. And then the examples tell us, okay, if you're taking somebody, let's say, to the baseball game, and you buy a hot dog and a beer, the hot dog and the beer is deductible, but the tickets to the baseball game essentially is not. If you had a suite at the game, all right, the payment for the suite is not deductible. And if the meals are included, the food and beverages are included as part of the amenities for the suite, they're not deductible because they're not separately itemized. If they are separately itemized and you pay for them separately, then they are deductible. Okay.
Yes. Can you
Yes,
imagine the trouble revenue agents are going to have in the future when they audit this issue?
yes, it is.
Who thought of this?
Um, and who is actually keeping up with, the line item in the expense reports or whatever it may be of exactly where the payment went. So it's going to be a challenge. And I would assume not a lot of revenue dollars are at stake. But on the other hand, for companies where they have large sales forces doing a lot of entertainment, there could be a significant amount at stake.
So that martini is now deductible.
The martini is deductible. 50% of the martini is deductible, but I'm going to come back to that in just a moment. All right. So moving on, again, I want to try to get through as many slides as we can. The deduction of costs paid with PPP loan proceeds. So I've already heard a mention of the Paycheck Protection Program loans and the tax consequences associated with those loans. As you may recall, initially, the IRS took the position under Section 265 that if you borrowed money consistent with the PPP program to fund salaries for employees and certain other expenses, which that's what the loan proceeds had to be used for. And then the loan was forgiven, okay, consistent with the program. You weren't allowed to take a deduction for those expenses of salary and other ordinary and necessary items. And the IRS took that position on the basis of 265. 265 disallows a deduction for any amount otherwise allowable, which is allocable to one or more classes of income, wholly exempt from the taxes imposed by this subtitle. All right. That caused a firestorm. And even members of Congress said that's not what we intended. We intended for taxpayers to be able to deduct expenses paid with PPP loan proceeds, even if they are later forgiven. And so, in fact, with the Taxpayer Certainty and Disaster Relief Act, okay, Congress overrode the notice where the IRS took the position that the costs were not deductible, notice 2020-32. And along with that, it became very clear that when that amount is forgiven, that PPP loan is forgiven, even though that income is exempt, all right, it's excludable from your gross income, it still will increase a partner's outside basis in their partnership interest or a subchapter S shareholders basis in their subchapter S stock. No different than other types of tax exempt income. And then, of course, when you take the deduction and the deduction flows through, that will have the corresponding decrease in outside basis. One interesting point here, and this is what I think is a little weird, and it's on, let's see, should be around page 14 of your outline. Yeah, it's at the top. Actually, it's the top of page 15. That a notice, our revenue procedure came out earlier this year, revenue procedure 2021-20, which states that if for some reason on your 2020 return, you did not deduct these expenses because you were following prior IRS guidance, right? And you didn't get the memo that Congress had overrode this provision, that you can actually take those deductions on your 2021 return. So this year's return. To me, that's a little odd because that's at odds with sort of the, is at odds with the annual accounting concept. You know, we can't normally take a deduction in 2021 for something we spent money on in 2020. So I guess here the IRS is saying, look, this is such a mess. We need to get it straightened out. We don't want a deluge of amended returns to deal with. So for this particular item, we'll allow a deduction on a 2021 return. Okay, now I said I was going to come back to the meal question, and that's what I'm doing now. So remember, the baseline rule is 50% of your meal expenses are, forgive me, that's my phone ringing in my office. 50% of your meal expenses are deductible. There are special rules that deal with meals served in the office, fringe benefit rules, things like that, where the employer can deduct 100% and the employee does not even have to include that amount in income. That's not what I'm talking about. I'm talking about the meals we pay when we take clients out to dinner, that sort of thing. Normal rule is 50%, okay? But we just had a pandemic. And the pandemic has forced restaurants to close, many of them, or they're certainly operating at reduced revenue. So again, Taxpayer Certainty and Tax Relief Act of 2020 tells us, it amends Section 274N2, and it tells us, nope, guess what? You can deduct 100% of that martini. All right. As long as you're paying for it before January 1, 2023. But it states that the deduction applied, the 100% deduction applies to meals provided by a restaurant. And of course, that necessitated further guidance from the IRS, which I've cited on page 16 of your outline. It's notice, I should have put the notice number in the slide. I apologize for that. But the new guidance is notice 2021-23. Notice 2021-23. And the purpose of that notice is to tell us what is a restaurant. All right. And the upshot, at least my take on it, is that you're, believe it or not, obviously we know what most restaurants are. Common sense will tell you that is certainly the case and is affirmed by the notice. But what about the food truck or the street vendors? Looks to me like those are restaurants within the meaning of this notice. But if you go to Whole Foods and you go to the, where they keep all the food, freshly prepared food out at Whole Foods, and sit down at Whole Foods, apparently it's not a restaurant, all right, because its primary purpose is to sell groceries. And as for caterers, you have a caterer for a client event, maybe. It's not clear if they operate a restaurant. I think you get the deduction. If they don't, it would seem perhaps the IRS takes the position you don't get the deduction, although again, this is just a notice. It's not binding. It's just the IRS's position. So we have a lot of uncertainty here. Again, not big dollars at stake for most of us, right? But you can imagine the budget for meals for, Home Depot or any publicly traded company. It could be significant. All right. So this is certainly not simplification by any stretch of the imagination. Next slide. Okay. And this one is on like-kind exchanges. In the outline, it's item E1 on page 21. So many of you may either represent so-called tenancy in common trusts or have had clients who engaged in a like-kind exchange and sold property and then used a qualified intermediary and then perhaps invested in a tenancy in common trust so that they qualified for like-kind exchange treatment under Section 1031. And those TIC trusts, tenancy and common trusts, have operated under guidance provided by the IRS since about 2000, I think. There's a limited number of things that the TIC trusts can do at the TIC trust level without turning the certificates in the trust into stock, okay? Because the idea is you're supposed to be investing in a tenancy in common, not in a security issued by, a business, right? And so these trusts must comply with those guidelines with the IRS to stay out of trouble and to make sure that your exchange will qualify as a like-kind exchange. Because of the pandemic, a lot of these trusts have had to modify their mortgage loans or their lease agreements. They've also had to accept or solicit cash contributions from the TIC interest holders. And as a result, the IRS has published the revenue procedure last year, augmented by a revenue procedure published just this year that's at the bottom of the slide, Revenue Procedure 2021-12, telling us that if your TIC trust has to make these type of modifications because of circumstances generated by the pandemic, that will not disqualify the trust itself. So this is, again, this is a taxpayer favorable position taken by the IRS here. So speaking of like-kind exchanges, let's talk about that for a minute. And this is on page 22 of the outline. As you may recall, hopefully you know this by now, Section 1031 was amended by the Tax Cuts and Jobs Act to disallow like-kind exchanges except with respect to real property. And that was, of course, a brand new rule. We had never had like-kind exchanges limited to real property. Predominantly, that's what 1031 was used for, but it could apply to exchanges other than exchanges of real property. So that put a lot of focus on exactly what is meant by real property. And, what about things like escalators and elevators and even sculptures that are inside a building? Is that real property or is that not real property for 1031 purposes? And so the IRS has issued regulations. They came out in December of last year. And these regulations define real property for us. And again, if you're advising clients, or certainly if you're representing qualified intermediaries, you'll have to pay close attention to these regulations. There are some things in the regulations that are commonsensical. That is that, the land is real property, the improvements to the land, the buildings, okay, are real property, but also inherently permanent components of real property are considered real property for purposes of 1031. So escalators and even cell towers are real property for this purpose. There's also some rules about assets considered real property under state law. And apparently some state law will define, for instance, an underground water pipeline as real property. And the regs essentially are kind of punting to state law and saying, we know we can't capture in the regulations everything that might be considered real property under state law. So we'll just provide a general rule that if it's real property under state law, then it is real property for 1031 purposes. So the example talks about an exchange of an underground water pipeline for a cell tower, and that qualifying as a like-kind exchange, when you might think that's nothing but personal property, the cell tower and the water pipeline, but it can meet the definition. And then the other one that was a little bit tricky was, what do you do about that huge sculpture in the middle of the building that theoretically you could get it out of there, right? You could take the doors off, take out some windows, and move the sculpture out of the building if necessary. But that would be incredibly costly to do so. And so again, this is a multi-factor test that you have to meet, but those types of sculptures or things that are designed specifically for a particular space in a particular building would seem to meet the definition of real property for this purpose. But then the regs also say, for instance, a modular drywall partition system, which I know nothing about, but I'm imagining, it's something like what we see in hotels, perhaps, where you can pull out a partition and move it around. That is not real property within the meaning of these the statute, section 1031. So long way of saying, again, if you're doing 1031 exchange, advising clients on 1031 exchange, make sure that they've taken a close look at these regs and are comfortable that what is being exchanged fits within the definitions of the regs. Okay, next item. This is a non-acquiescence, IRS non-acquiescence to an older case. The non-acquiescence was published on April 12th of this year, and the IRS non-acquiesced to Schreiber versus Commissioner, which was a TC memo case. And we think it's an important case. My co-authors and I think that this is an important case and an important non-acquiescence to talk about, because it relates to is what considered an asset under section 108. So if you'll remember, section 108 provides for certain exclusions from gross income, a number of different exclusions, but one of them allows an exclusion to the extent a taxpayer is insolvent. So the question then, and insolvency means, liabilities over assets. So the question then becomes, okay, what assets have to be counted to determine whether or not I'm insolvent for purposes of section 108? And so it's, it's sort of this odd circumstance where a taxpayer is really wanting to be as poor as possible, right? They don't want anything to count as an asset. They would like to have as much as possible not be considered an asset for purposes of section 108. Well, that's what happened here. Retired police officer had $418,000 and change in debt canceled. He and his wife filed a joint return, excluded the debt cancellation because the taxpayer maintained that they were insolvent. All right. But the taxpayer did have a defined benefit pension plan, and so was receiving monthly payments for life from the pension plan. And so the IRS is heartless, aren't they? The IRS said, nope, that's an asset. Your expectancy, we can present value that pension plan, and your expectancy from that pension plan is an asset. And that means that your liabilities don't exceed your assets for tax purposes. So you don't get to exclude this amount. The tax court mercifully held for the taxpayer and said, no, this is not an asset because you can't really turn it into cash immediately. You can't go to the bank and borrow against it. You know, you don't have the right to even use it as security. So this is not what Congress meant when it was talking about, you know, an asset. The IRS has decided, I think this case was decided in 2017. It was, all right. And it took the IRS 4 years, and the IRS is now taking the position we disagree with Schreiber. And that means if the issue comes up, the IRS will litigate the matter.
Does seem like that's fairly heartless.
Yes, I would agree. A retired police officer? Okay, a retired tax lawyer, I would agree. We should slap the book at him, right? But a retired police officer? They're the good guys. So anyhow, we think it's important because it's a reminder of, you know, we need to think about what may or may not constitute an asset when we're thinking about the 108 insolvency exclusion. And obviously the IRS is clued in on this issue. So the next item is there are a few items here I just want to mention quickly, but the exclusion for cancellation of qualified principal residence indebtedness has been restored. That was late last year. And the provision had expired, and the Taxpayer Certainty and Disaster Tax Relief Act has restored the provision through 2025. So that's obviously a good development for taxpayers that are you know, facing foreclosure on the home, for those doing short sales, although, you know, these days it seems like the residential real estate market is going gangbusters. But also, this is something I just want to mention at the bottom of the slide here. Georgia is not one of these states, but there are states that have so-called anti-deficiency statutes. California is one, and I believe North Carolina is one. And those anti-deficiency statutes actually mean that when the creditor comes after the homeowner for failure to pay their mortgage and the house is sold, let's say in a short sale, and the homeowner doesn't have enough to make up the difference, the deficiency, the creditor can't come after the homeowner for that deficiency. And under the Simonson case decided a few years ago, the tax court held that means that's non-recourse debt. It's not recourse debt, it's non-recourse. And as a result, 108, the exclusion doesn't apply because you will remember under Tufts and Crane, those old cases, that when you have a satisfaction of non-recourse debt, that just gets added to the amount realized, right? It's not forgiven, even though it goes away in the same manner as it would if it were recourse debt in a short sale. So that again is for our clients in Georgia dealing with principal residence indebtedness and exclusion, they should be fine. But just keep that in mind that state law, another good reminder, state law can influence the terms of the debt, and the terms of the debt, whether it's recourse or non-recourse, can have a significant impact on the tax analysis. So that's why we like to talk about this case. All right, the next one is cancellation of student loans. This one too, I will just simply mention good news for our students who can have their loans canceled. This was the recent American Rescue Plan of 2021. So it's broad enough, the exclusion is broad enough in 108 F5 to exclude most post-secondary educational loans. And just note the exclusion doesn't apply if, for instance, you know, you're performing services for the institution. what's happening is the loan is being forgiven in exchange for your performance of services. That the exclusion does not apply there. This is just simply when the loan is forgiven. Okay, and it applies from now until January 1 of 2026. The next item, all right, is deduction of state and local taxes. So you'll remember, go back to the Tax Cuts and Jobs Act, and Congress limited the deduction for state and local taxes. My personal deduction to, I file a joint return with my wife, to $10,000, all right? That included my state income taxes, it included my property taxes. I don't come anywhere near 10,000, but a lot of people do. And you can't take more than 10,000. Now that doesn't relate to your business taxes, all right? Those are still deductible, state and local business taxes. These were your personal taxes. There was a lot of confusion about this because some of the states that were affected more than others, New York, New Jersey, Connecticut, tried to enact these workarounds. And the IRS came down hard and said, nope, you know, if it looks like a duck, quacks like a duck, walks like a duck, it's a duck. We don't care what you call it under, you know, state law. It's going to fall within the $10,000 cap. All right. So we went round and round, and you'll see in the outline, we go through pages and pages of the IRS's response and so forth and so on. But what then may have escaped the attention of some folks and is worth mentioning here is this notice 2020-75 that came out in November of last year. And it tells us that the IRS is going to issue proposed regulations relating to this issue of the deductibility of state and local taxes, but it's going to clarify that state and local taxes paid that are imposed upon and paid by a flow-through entity, a partnership or an S corporation, are allowed as a deduction. And they're allowed as a deduction to the partnership and S corporation when it computes its non-separately stated income, its so-called bottom line income. So it gets to take that deduction in computing that bottom line income that then passes out to the shareholders or partners, and they include on their individual returns. And what is now happening, it seems to me, and I just saw this in a news item the other day, is some states, and Arkansas, for instance, has passed a statute which says that a S corporation or partnership, including LLCs, of course, in Arkansas, can apparently elect to pay income tax at the entity level on behalf of its partners or shareholders and credit them for that payment. And it appears to me that based on this notice, the IRS is saying that's okay. We will allow that as long as it truly is a liability of the entity itself, right? That it's not simply figuring out what each partner owes or a shareholder owes and you decide to send the check from the company. No, it's really a tax imposed upon and enforceable against the entity. Then that means that tax doesn't have to be included in the 10,000, that you get on a personal level. I would watch this one to see what develops, but it would not surprise me if many states, Georgia included, passes something along these lines that you can elect into this tax regime. Okay, next item. Deduction of mortgage insurance premiums. I want to just mention that one. This is good news for our new home buyers, that they can take a deduction for those mortgage insurance premiums, just like they could for interest. That is in effect through this year. Okay, just through the end of the year. It's been extended over and over again. Wouldn't be surprised if it gets extended again, but at least we got it for this year. There's another provision I will simply highlight because we're getting not too far from the hour, which is the ability of an employer to provide educational assistance to my students. Thank you. You can provide educational assistance to my students. And under section 127A, that's excluded from their gross income up to $5,250. Now, this new code section, and this was under the CARES Act, this new code section 127C1B temporarily expands the definition to include repayments of qualified education loans as defined in the statute. So, and this is effective through December 31, 2025. So an employer's payment on behalf of an employee of a qualified education loan, assuming you meet the definitions, educational assistance, qualified education loans should be excludable under 127C1B. And so that again, might be a nice thing to do for one of my students, perhaps. Okay. How about Deckard versus Commissioner? All right, I like this case. I'm going to go out on a limb here, and I think this case, if it gets appealed, gets reversed. And I just think the tax court got it wrong. And this was a full tax court decision. So here, Mr. Deckard was the president and one of the 3 directors of a Kentucky nonprofit corporation. And I think he had good intentions of funding good works, but for whatever reason, was unable to secure tax exempt status and had essentially funded some of these good works, and it was not, or wanted to take the position that the amounts expended were deductible expenses in a trade or business, but the entity had been formed as a nonprofit corporation. And so probably I can see it now, meeting with your tax advisor. How can I get the benefit of all this money that I've spent? I can't get a charitable deduction. Is there some benefit I can get? The tax advisor says, how about we make an S election? I know this is a nonprofit corp, but let's make an S election. We can make an S election for an LLC. You know, it doesn't always have to be a quote corporation or a business corporation. I know you can make an S election for an LLC. Why can't we make it with a nonprofit corporation? You're the sole, you're in control. You know, you're the one who provided the capital contributions. Let's give it a shot. The IRS, of course, said, oh, wait a minute, this is a nonprofit corporation. It doesn't have stock. Nonprofit corporations don't issue stock. They can have members, but they don't have stockholders. And if you can't have a stockholder, how can the stockholders make a subchapter S election? And so the tax court adopted the argument of the IRS and said, sorry, Mr. Deckard, your S election is invalid. The reason why I think this, if it gets appealed, is overturned is because, you know, nonprofits are not automatically tax exempt. I can form a nonprofit, not apply for tax exempt status, and it's abundantly clear that that is treated for federal income tax purposes as a C corporation. And so if the IRS tells me I form a nonprofit that doesn't have that's not tax exempt, and it is a C corporation, why can't I make a subchapter S election? I think the test should be for beneficial ownership, not whether or not the corporate statute treats your ownership, your control, as stock or not stock. Weird case. Nobody would plan into this. I'm not advising you use a nonprofit corporation and try to get S corporation status. Not at all. I'm pointing it out merely because, you know, I'm not sure this is really good law in this area. And it would be a case that if I had this same case come before me, I wouldn't hesitate to take it to tax court again. Okay. I'm just going to highlight the remaining items that I have. I know there are a lot, but pay attention when you have time to broker tech holdings. It's all about whether or not non-shareholder capital contributions can be excluded from gross income. The law for years and years and years allowed that. This case under old law disallowed it for reasons that are explained in the outline. But it's a great reminder that the Tax Cut and Jobs Act amended Section 118 so that non-shareholder contributions to the capital of corporation by any governmental entity or civic group, you know, a contribution to Kia by, you know, a local county government to put your plant in the county, that used to be excludable from gross income, is no longer under Section 118, and that's clear. And probably, again, for reasons discussed in the outline, or almost certainly would not be excludable if contributed to a partnership. Carried interest, big firestorm about carried interest, profits interest. Tax Cut and Jobs Act made changes. Now there's regulations underneath that change. All right. And regulations are way too extensive to talk about here. 34 defined terms, but what it does confirm is that 12, if you sell your carried interest before holding it 3 years, which was what was imposed by new Section 1061, if the gain is 1231 gain, not 1221 long-term capital gain or capital gain, that's not what the statute applies to, that it doesn't transmute 1231 gain into ordinary income. The practical effect of that is our real estate partnerships, all right, which are the ones that often use these carried interests, right? You give a promote to the general partner, all right? That means that really 1061 doesn't have any teeth for the real estate partnerships. I mean, there may be some aspects for personal or other types of assets held by those partnerships, but for the real estate subject to 1231, 1061 is really a paper tiger, okay? All right, let's see here. Exempt organizations developments, I will just skip over that slide and to the next one, which will tell you we now have more liberal rules for charitable contribution deductions. Even if you itemize like me, don't itemize like me, take the standard deduction. I know all of you are you have tons and tons of deductions. I'm just a government employee. I take the standard deduction. And, but I used to couldn't take a charitable contribution because it was wrapped up in my standard deduction. I couldn't separately itemize. Well, that's been changed. So you can now a couple can actually get a $600 above the line charitable deduction, even if you otherwise take the standard deduction of $24,000. So this is my pitch for all of you to remember Georgia State in your charitable contribution plans when you take that $600 deduction. Okay. And also there's liberalized changes to the caps, Remember the charitable contribution caps? Those have been liberalized as well. Okay, so I only have 2 slides left. I think what I will do is try to summarize very high level these remaining 2 slides. And what these 2 cases are about, the statute of limitations, the 3-year statute of limitations for assessing taxes. And in various different ways, there were problems with the tax returns filed by these taxpayers. One of the cases, it didn't include the personal identification number that we use if we file electronically. Another was a failure to withhold the backup withholding form when the taxpayer had done a bunch of 1099s without the payee's tax ID number. All right, so the taxpayers had fouled it up a little bit in the way that they filed their return. And then the IRS comes after them, but they come after them outside of the 3-year limitations period, beyond the statute of limitations. The IRS argues, of course, that the return was not validly filed, so it didn't start the statute running. In both of these cases, the court said, wait a minute, if there was sufficient information on what was filed, notwithstanding these technical deficiencies, if there was sufficient information on what was filed to put the IRS on notice about auditing the taxpayer, that is a good return for starting the statute of limitations. So in both of these cases, the last 2, the taxpayer won on, I believe, summary judgment grounds, dismissing the IRS's assessment because it was beyond the 3-year statute. Okay, with that, I'm going to stop. I think I may have gone a minute or so over. Jeff, I apologize.
Thank you kindly. You've not gone over. There's a couple of related questions. Would you like to talk about them now or wait till later? Both about the SALT workaround.
If I have just a minute, let's see. Oh, are these questions in the chat, or I see them? They're over here in the Q&A, right? Didn't Georgia already pass? If they did, Julian, Fortuna, I am sure you're right, Julian. I have no doubt that you are right. So thank you. If you will guide me to the appropriate place to look, I would love to have that. Oh, here's another one from, let's see. Oh, it was House Bill. Julian said House Bill 149 was signed by the governor and is in effect. Someone else mentioned that to me as well. So see, I always say, learn something new every day, and I did. Thank you.
Cass, we greatly appreciate it. Next, I'd like to introduce Emily Yohn. Emily Yohn is a practicing attorney, and Emily is a supervising attorney at the Georgia State Low-Income Taxpayer Clinic. And I know a lot of us have had some contact with former students at the clinic. Some of us have had the opportunity to refer clients to that clinic. And Emily would like to take 5 minutes to tell us about what the clinic does, what she does there, and how she can, or we can, as the tax bar, increase the use of the clinic and have some synergy with them.
Okay, well, thank you for having me here today to talk a little bit more about the tax clinic. As Jeffrey said, my name is Emily Yohn. I am a supervising attorney at the tax clinic. I have been at the clinic about 3.5 years in a full-time capacity, but I feel uniquely qualified to talk about the clinic because I also spent 5 semesters in the clinic as a student. So just a brief little overview about the clinic. Although this is nothing there are official records, but I do believe we are the largest low-income taxpayer clinic in the country. And we've been around for about 29 years and are getting ready to have our 30th anniversary, I believe, next year. So during this time, we've had countless number of students come through our doors, and then we've also been able to help countless number of low-income tax clients. So One of my favorite things about the clinic and my job is the dual purpose of the clinic. So we are here to assist low-income taxpayers with controversies with the IRS. So we have a grant with the IRS, and so we operate within low-income limits. Right now, that's going to be 250% of the federal poverty level. So for a household of one, that's approximately $32,200. And for a household of four, that is $66,250. So for a majority of our clients, our cases are in collection, so we're dealing with that process. But we also do handle a lot of cases where refunds have been denied. We see a lot of things like earned income tax credit being denied, and so we assist the taxpayers to get those refunds that are so greatly needed for everyone, but particularly for our low-income clients to get the money that they need. But as important as that is, it is equally important to us to educate our students. So what we want to do is we want to make sure that the students have a great opportunity in the clinic to learn about the tax controversy process, but also learn things like the skills that maybe you don't get in your law school classes, like client communication and things like that. So as a clinic, we do operate year-round. We have students in each of the semesters, so we operate in the fall, the spring, and the summer semester. Students can participate in Clinic 1. If they enjoy Clinic 1, which we hope they do, they can come back for Clinic 2. Both of these clinic classes are for academic credit, and they receive 6 credit hours. So when I was in the clinic, we only received 4, but in acknowledging the hard work the students participate and put in, we were able to get that raised to 6. For students that really enjoy themselves in Clinic 1 and Clinic 2, they also have the opportunity to stick around, not for academic credit, but as a graduate research assistant. So that's how I was able to spend 5 semesters in the clinic because I acted as a GRA for several semesters. Generally in the fall and the spring semesters, we have between 20 to 24 students. In the summer, our enrollment is a little bit smaller. Typically, it's between 12 to 15 students. Students in the clinic, they manage their caseload. Depending on the semester and the experience level, they are typically handling between 12 and 20 cases. So that is a lot for our clinic students. But again, that's what makes it such a great experience is that hands-on approach that we have. We do meet with them weekly and we supervise them. I say we, I'm the supervising attorney, so I generally am meeting with Clinic 1. Ted and Tamika, the director and the associate director, they are also meeting with students as well. So one of the things I like to say is that the tax clinic is a great experience for students, even if they end up having no interest practicing tax law. Obviously, today we all love tax law, and so we do develop a lot of students that had no interest in tax when they started the clinic, that change and they decide that they want to practice tax law after they graduate. So again, one of the main things I think is just the defining factor in the clinic is that hands-on that the students have. So they're the one that manage their caseloads, they're calling clients, they're sending the emails, they're sending the letters. We hope to have more opportunities for the clinic students to meet with their clients in person now that things with the pandemic are getting a little bit better.
Emily, in the last minute we have, can you tell us how the tax bar can possibly help the clinic?
Yes. As Professor Brewer said, if you feel the need to donate to the law school, that is always one way you can, and you can specify your donation to the tax clinic on the website. But more importantly to me, our goal is to get our students hired, whether it's while they're a student acting as a law clerk or after they graduate. So if you have hiring needs and things like that, definitely think about the tax clinic, send us an email, let us know what you're looking for, and we would love to send you some of our students your way. We love to see the Atlanta tax community grow and to see all of our students, get settled in their career.
Emily, thank you so much for spending time with us today. I did forget to mention that you got both your JD and your joint MBA at Georgia State.
Yes.
Thank you so much. We'll hope to see you again.
Thank you.
Well, our next esteemed speaker is George Abney, a friend of mine. George is a former prosecuting attorney with the Justice Department. Now he's a partner with Alston and Bird, got his BS at Columbia and his law degree at Florida State. And George, this is always a subject close to my heart. What is the government going to do? What's the IRS going to have in store for us?
Yeah, thank you, Jeff. Pleasure to be with you all today. And it's a real honor to follow Professor Brewer and also Emily. Again, thank you. And again, we'll try and cover a lot of ground here in this presentation today. I'm going to share my screen with you if I can figure out how to do that. Let's see. Jeff, is that working? Can you tell?
No, we're still looking at you.
Okay.
Look for that green button.
Oh, here it is, share. Okay, now I think it's working. So, okay, good. Well, thank you all. Thanks, Jeff, for inviting me to participate today. As Jeff alluded to, this is sort of a topic that's near and dear to his heart. You know, what are the enforcement priorities in the Biden administration, tax enforcement priorities? As many of you know, Jeff specializes in tax controversy work, and that is my area of specialty as well. So I'm always trying to figure out what the IRS is going to do in terms of its tax enforcement priorities. And of course, as all of you know, that can change sometime from administration to administration. So obviously, the Biden administration is still fairly new. So we thought it would be a good topic to share with you all what the Biden administration is proposing to do in terms of IRS audit and enforcement priorities. So let's go to sort of a general outline here. We're going to talk a fair amount about the tax gap. Many of you have heard about the tax gap or read about it in the news. Then we're going to talk a little bit about the sort of high priority audit and enforcement issues that the Biden administration IRS has announced so far. And then if we have time, we're going to talk a little bit about best practices and strategic considerations that you may want to use in preparing your clients for audits or other tax controversy matters. So let's talk a little bit about the tax gap. Closing the tax gap has been all over the news lately. As you can see, these are just some recent headlines about the tax gap. Of course, the tax gap is the amount owed versus the amount actually paid. And we're going to talk a little bit about how the IRS calculates that tax gap in a few minutes. But the Biden administration is proposing, as the headlines say, to beef up IRS enforcement significantly, up to $80 billion to increase IRS enforcement efforts. And the predictions are that that will raise some $700 billion in revenue over the next 10 years or so. So, but what are the details behind the tax gap? What are the details behind the headlines? Of course, the Biden administration has many legislative ideas and proposals, laws that they want to enact. One of those is called the American Families Plan. And that plan, as some of you know, is designed to increase funding for things such as universal pre-K education and funding 2 years of community college for free. But those things cost money. And in Congress, in most circumstances, before you can pass a new law that's going to require significant outlays, you also have to provide some means of funding those new programs. And so the American Families Plan, which is fairly ambitious in terms of new social programs, is coming up with a way to pay for that. And the way to pay for that is to close the tax gap, close the difference between what is owed and what is paid. And also in the published information about the American Families Plan tax agenda, there's a significant language about increasing the fairness in the tax system. So let's go into a little bit more about details on the tax gap. How big is this tax gap? Well, we alluded to that earlier. They want to raise about $7 trillion over the course of the next, they want to raise a significant amount of money over the next decade by closing the tax gap. The tax gap is estimated to be $600 billion in 2019 and will rise to almost $7 trillion over the course of the next decade, roughly equal to 15% of all taxes owed under the current tax system. So here's a little breakdown, which helps give you some additional information about tax gap estimates and projections. And it compares the tax gap from tax year 2011, 2013 through the 2019 projection and then 2019 adjusted. And interestingly, over here on the left-hand side of the column, you'll see different categories. You have the non-filing tax gap, you have the under-reporting tax gap, and then you have the underpayment tax gap. And we'll talk a little bit more about that. But this is all published in the Biden administration tax explanation of the tax plan that it wants to put in place and the enforcement priorities that it wants to put in place in support of the American Families Plan. So a little bit more about how they measure the tax gap. There's, as we talked about earlier, the non-filing tax gap. And that, according to the Biden administration, represents about 9% of the gross tax gap. Of course, there are people out there who just choose not to file tax returns. Fortunately, not too many of them. Then you have the underpayment tax gap. This is people who will file their tax returns, but then just not pay, either because they don't want to pay or they don't have the ability to pay. And that represents, according to the Biden administration, about 11% of the tax gap. And then, of course, the largest component of the tax gap is the underreporting tax gap. That, of course, represents individuals or entities who file, they pay what they owe per the return, but there is underreporting taking place through a variety of means. So, that represents about 80% of the tax gap. So it would seem to make sense for the Biden administration, if they want to close the tax gap, to focus on underreporting while not ignoring non-filing and also not ignoring the underpayment tax gap. So how does Treasury actually go about measuring this tax gap? And this is, somewhat interesting, because how do you know there's a tax gap? Of course, you can't just go out there and ask people and do random surveys and ask them, well, how much did you really owe, as opposed to what you put on your tax return. So Treasury has to engage in some fairly sophisticated statistical, employs some fairly sophisticated statistical analysis in order to come up with the actual tax gap. And the key
George, I've seen a few articles in the Wall Street Journal and other places with widely varying estimates of the tax gap. Is it always just going to be an estimate?
Yes, I think it is always going to be an estimate. And, what they say about statistics, they're lies, damn lies, and statistics. So a lot of people are just naturally skeptical of a statistical analysis. But I think the government does have to at least try to measure the tax gap. And they do it in basically two ways. The first way is they do estimates based on random audits. Of course, the IRS conducts random audits, targeted audits all the time. And from those audits, they can determine what they think the tax gap is. Of course, if they audit 100 different returns and they determine that the tax gap is roughly 15% from those 100 different returns, and they can extrapolate from there and estimate that there would be approximately a 15% tax gap if they audited all of the returns. Well, of course, you can see that there are limitations in that approach. What if the 100 returns that they audit are problematic in some way and they don't catch certain sophisticated tax avoidance or tax evasion schemes? How do you determine what taxes are due or the component of the tax gap based on underreporting? So there's some limitations to this sort of random audit statistical analysis. So what the IRS has been doing recently to sort of make up for that gap, or those limitations, is they've been engaging in something called detection controlled estimation. And that's sort of a fancy statistician's way of trying to determine what amount of the tax gap do they actually catch, or how much underreporting do they actually catch when someone is audited. And the IRS has taken the position, and this is based on a Yale Business School professor's statistical approach, but the IRS is taking the position that sometimes when they send a revenue agent out to conduct an audit, that revenue agent does a really good job and catches pretty much everything that could be caught in terms of underreporting. The IRS acknowledges, though, that some of their revenue agents are better than others. And so they send revenue agents out sometimes who don't quite catch everything that they should catch. And so the IRS, in conjunction with this professor at the Yale Business School, have come up with something called detection controlled estimation. And this is a statistical analysis where they attempt to add to the tax gap an additional amount that they think that their auditors might miss. So for example, if the IRS audits 100 different returns and they realize after those audits that roughly 20% in additional taxes were due, now the IRS is factoring in that perhaps the auditors who conducted those audits didn't quite catch everything. And so they're adding an additional amount on to that 20% estimation, maybe 3% or 5%, depending on the specific documents they use. But it's interesting that they are not only using random audit analysis now to measure the tax gap, they're also increasing the amount based on errors that they think their own revenue agents might make when they conduct audits, essentially acknowledging that their revenue agents can't catch everything. So that's sort of how they go about trying to measure the gap. And again, these are all estimates. There's no way to determine with any certainty what the actual tax gap is. So as you can imagine, I'm sure outside interest groups and politicians will challenge the estimates that the IRS is using from time to time. So let's talk about who is responsible for the tax gap. And this is a quote from the American Families Plan tax agenda. And I think it's pretty revealing, and perhaps the most revealing aspect of the American Families Plan tax agenda. And research finds that the underreporting tends to rise with income when taxpayers are ranked by their total income. In part, tax evasion rises with higher incomes because higher income taxpayers have sophisticated accountants and tax preparers who can stake out aggressive tax positions to help hide the true liability. And because the IRS lacks specialized auditors, they can't pursue all of these instances of noncompliance. That impacts deterrence. People think they can get away with it, and they think their chances of being caught are relatively slim. So they're just going to continue not to comply. And that, I think, sums up a lot about how the Biden administration is going to approach tax enforcement over the next couple of years. They're going to focus their efforts on high-income taxpayers. They are convinced that high-income taxpayers have access to sophisticated tax accountants and other tax professionals who can stake out aggressive tax positions. And they are also going to focus their efforts on those sophisticated accountants and tax professionals as well. So,
George?
Yes.
This is Andy. May I pass on a question we got from the audience? I think this
Sure.
is a good place to put it. So this focus appears to be on wealthy individuals. This is a question from Robert McGurk. But is the tax gap, is it attributable in any way or largely to small businesses and individuals who are paid on a cash basis? Is this, I guess, another way to put the question is the Biden's focus on wealthy individuals appropriate and accurate based on how the tax gap is actually created?
Yeah, I think that's a good question. And thanks for submitting that question. And thanks for bringing it to my attention, Andy. So if you read through the American Families Plan tax agenda, it does talk about wealthy individuals who often own their own businesses. And they have a lot of control over how their business makes payments, how their business reports payments to the IRS. And so it's kind of hard to really separate wealthy individuals from what the Biden administration would consider wealthy business owners, because in their American Families Plan tax agenda, they kind of talk about the individuals who own their own businesses and those individuals having control over how payments are reported from their businesses. So it's almost as if the wealthy individuals and the wealthy sort of small business owners are treated as the same under the Biden administration's worldview, if that helps answer the question.
Yeah, thank you.
And a good example of that, and I'm not expressing an opinion one way or the other, many of you have probably seen in the news that I believe the CEO of the Trump organization was indicted recently. And of course, the allegation there, and it's just an allegation, is that there were certain payments being made as compensation to employees of the Trump organization. And those payments were not being reported as income. And so that just highlights sort of an example of sort of a wealthy individual who owns their own business and having a lot of control over how payments are reported to the IRS. And of course, well, in that case, in the Trump case, it's the New York Attorney General, but the taxing authorities raising questions about whether everything was done properly. So they're going to go after wealthy people. They're concerned about sophisticated tax professionals. There's a lack of IRS sophistication. The IRS doesn't have sophisticated revenue agents necessarily to pursue some of these tax schemes. That leads to very little deterrent effect, and that leads to underreporting. So who else might be responsible for the tax gap, at least according to the Biden administration? We talked a little bit about this in answering that question, but the Biden administration has raised concerns about the current information reporting regime. Of course, all of you are familiar with the fact that numerous financial transactions have to be reported to the IRS. Of course, the simplest and most obvious is the W-2 reporting system, and then you have the 1099 reporting system, and then all sorts of other reporting systems. But the Biden administration, in its publications, is asserting that the current information reporting regime has numerous gaps, and those gaps lead to tax avoidance or tax evasion schemes. And this is a chart from the Biden administration American Families Plan tax agenda. And you can see over on the left-hand side, they have a graph here showing the amount of underreporting attributable to payments where the income is subject to both reporting and to withholding. And of course, that's your traditional W-2 reporting where the income is reported and simultaneously taxes are withheld. And so that obviously represents a very small percentage of the tax gap. Moving over to the right, you have income that's subject to information reporting, but not withholding. And of course, that would be a typical 1099 situation. Then the third column shows income subject to some information reporting. So it would be limited. Perhaps that's currency transaction reports or suspicious activity reports or other types of reporting. And then, of course, on the far right, you have income subject to little or no information reporting. And that's, according to the Biden administration, where the overwhelming majority of the tax gap is arising from. And I'll just share with you kind of a story briefly about a client I represented years ago that I think kind of puts this sort of concept, or is a good illustration of this concept. So I had a client many years ago who actually was not under audit by the IRS, but he was involved in another dispute. And his tax returns and his bank accounts were brought to light in that dispute. And it turned out he had a lot more money going into his business bank account than was ultimately being reported on his tax returns. And of course, we had to hire a forensic accountant to review everything. And as it turned out, the funds, the income reported on his tax return matched to a penny all of the 1099s that he received. However, if he didn't receive a 1099, that money went into his bank account, but it never got reported on his tax return. And so that just sort of highlights kind of a common way that the information reporting regime does encourage tax compliance and accurate tax reporting. And so the Biden administration is stating very clearly and very publicly that they want to change that and require additional information reporting. So let's talk a little bit more about what else is responsible, or who else is responsible for the tax gap. And this is a slide that I think, and again, this is from the published American Families Plan tax agenda. This is highlighting the technology shortfalls that the IRS has. I think we have some IRS folks participating today or in attendance today. And as tax practitioners, almost all of us are familiar with what's called the individual master file system at the IRS. And as many of you know, that individual master file or IMF system leaves a lot to be desired. If you've ever tried to take a look at an IRS account transcript generated by the IMF system, it's very difficult to understand. They're not exactly plain English, and they could stand some improvement. And according to the Biden administration, the IRS has been using this IMF system since 1962. It's almost 60 years old. It's written in a programming language that is not even taught anymore. And you have only a small number of IRS employees who even know how to use the programming language that the IMF system is designed around. And in fact, many of those individuals are eligible to retire. So think about, how your business or your law practice would be impacted if you were using a computer system that was 60 years old. Most of us have some sort of a technology refresh at least every 5 years or so because we have to update our systems. The IRS has not updated its system in about 60 years, and that's a real problem, especially in this age where the world is shrinking and you have international monetary transactions and lots of different reporting requirements under the Bank Secrecy Act. And so the IRS is collecting lots and lots of information from financial transactions all over the world and from financial institutions. But do they have the internal technology to really be able to analyze all of that data that they're collecting? And of course, if you're working with a 60-year-old system, and the IMF system is not the only system the IRS uses, but it is their primary system. If you're trying to analyze all of that data and make use of it, it would be very difficult to do that using a system that is so old. So again, who is responsible or what is responsible for the tax gap? The Biden administration is stating that budget shortfalls are a concern. And this is a chart that the Biden administration has published showing the IRS budget as a percentage of gross domestic product over the last 20 years. And this represents about a 30 to 35% decline in the IRS budget related to gross domestic product. Now, of course, this isn't in real dollars, but if you looked at raw dollars, from 2010 to 2021, the IRS budget has fallen in real dollars by about 18.5%. So obviously the country is growing. The IRS is tasked with more and more responsibilities all the time, and yet their budget is shrinking in real dollars and of course as a percentage of gross domestic product. And again, according to the Biden administration, the number of revenue agents who are the primary auditors for the IRS is down 35% in the last 10 years, and that the IRS now has fewer auditors now than it has had at any time since the Second World War, the end of the Second World War. So the IRS is clearly falling behind, at least in terms of revenue. Well, what is the impact of this decrease in revenue? And of course, it's easy to put 2 and 2 together. You're going to have a decline in audit rates. And here are the statistics that the Biden administration is publishing with respect to the decline in audit rates. So you have the percent audited in 2010 here on the left-hand side. In the middle, you have the percent audited in 2018. Those are the most recent statistics available. And then you have a percentage decline over on the right-hand side. So, and then the filer categories are broken down, and we can focus on individuals with income over 1 million, 1 million to 5 million, 5 million to 10 million, and 10 million plus. The audit rates for those individuals, which would generally be considered high income individuals and business owners, were the highest back in 2010. 8%, roughly the highest, 6%, 11%, and 18%. The only higher category being large corporations. Those audit rates for those high income individuals have fallen by the greatest percentage from 2010 to 2018, down 61%, 63%, 63 and 63%. You see over on the right-hand column. So according to the Biden administration, they want to pursue higher income individuals in terms of dedicating their audit resources. And part of their explanation for that is that the percentage audit of those higher income individuals has actually decreased significantly over the last 8 years or so, or 10 years, and they want to make up for that. So in sum, it seems fairly simple. You know, that if we have a tax system, we should all want people to comply with that tax system, and we should all want people to pay what they owe under the law. And perhaps that's something that Congress could agree upon in terms of funding the IRS so that it can meet the goal of shrinking the tax gap and ensuring that people are paying what is actually due. And of course, former administration officials have come out in support of this. This is a fairly recent New York Times editorial from former Treasury Secretaries Geithner, Liu, Paulson, Rubin, and Summers, and these individuals served under Republican and Democratic administrations, and they are all in favor of what the Biden administration is proposing. So perhaps we will have some sort of moment here where Democrats and Republicans can come together so that we can enforce the tax laws that we have in this country.
George, this is Jeff. Something tells me that nothing can escape becoming political anymore. And although common sense would tell you the government needs more money, and if they give more money to the IRS, they're going to reduce the tax gap and we'll have less of a budget deficit. But is there a legitimate argument against increasing the IRS budget other than something overtly political?
Well, yes, I think there probably are some very legitimate arguments. I think you could argue that perhaps there's some waste within the IRS and they could streamline their processes and procedures to eliminate redundancies and waste. And I'm sure some of those arguments will come out in due time. What we're seeing now, however, is the parties are lining up against this. And this is a recent article from The Hill, which is a publication in Washington, D.C., by Steve Forbes and Stephen Moore. Stephen Moore is a former Trump administration official. Steve Forbes, as many of you know, ran for president several years ago. His primary goal was to impose a flat tax, which some people support, some people don't. But they are coming out very much against the Biden administration's proposal to add funds and add additional resources to the IRS. And they're essentially saying it's a bad idea, and it's an idea that only tax accountants, tax lawyers, and DC lobbyists could love. And obviously, some on the right are opposing what the Biden administration here is doing. So perhaps it's not going to be a situation where Republicans and Democrats can agree on what we should do about the IRS to increase IRS funding. Another article in the Washington Post recently sort of highlighting some of the organizations that are opposed to any additional IRS funding. This is from July 8th. Organizations such as the Committee to Unleash Prosperity, Freedom Works, the Conservative Action Project, and the Leadership Institute are circulating letters on Capitol Hill opposing any additional IRS funding. They want absolutely no additional funding for the Internal Revenue Service.
Well, there you have it. There's the argument. It doesn't seem to hold a lot of water, but I don't understand how anybody can be happy with the system knowing that you're paying your fair share, but your neighbor isn't.
Right. And I think that's absolutely right, Jeff. And unfortunately, and I'm sure everybody in our audience is familiar with this, but a lot of times when legislation is proposed, people stake out extreme positions with the hope that somehow when the legislation ultimately passes, it will be somewhere in the middle. And so it's hard to say exactly what some of these organizations are thinking. Do they really want to have zero additional funding for the IRS, or are they staking out an extreme position in hopes of perhaps meeting somewhere in the middle? As an aside, many of you know who Elizabeth Warren is, a senator from Massachusetts who ran for president, and she is seen as being one of the most far left members of the United States Senate. She recently introduced a bill that would increase IRS funding significantly more so than what the Biden administration is proposing. And she also included in her proposed bill taking the IRS out of the annual congressional budgeting process so that its funding would not be subject to the annual whims of Congress, and it would be put on par with things such as Social Security and other government programs that Congress does not touch very often. So that's another extreme example. Perhaps some of these folks on the right are just putting out these extreme proposals with the hope of influencing the debate. And then you're seeing on the left additional proposals that are even more extreme than the Biden proposal. And then hopefully they might meet in the middle. But certainly there's significant opposition to increasing funding for the IRS. But I understand your point, Jeff, that it certainly seems reasonable that if we're going to have tax laws on the books, we ought to devote resources sufficient to enforce those tax laws. And I hear some cheering from the IRS representatives who are on the call right now or participating in the webinar. So let's just kind of recap the tax gap here. Estimate of 600 billion to 7 trillion. Attributable to budget shortfalls, attributable to a lack of information reporting, attributable to outdated technology. That leads to declining audit rates. You also have higher income taxpayers taking aggressive tax positions, and then you have sophisticated tax practitioners who are perhaps encouraging higher income taxpayers to take these aggressive tax positions. So to summarize, how does the Biden administration want to address each of these bullet points? Budget shortfalls. Well, that's easy. The Biden administration wants more money, but that has to go through Congress. Lack of information reporting. Well, new laws and new regulations. Perhaps the Biden administration can impose some new information reporting obligations, but in all likelihood, a lot of that would have to go through Congress as well. Outdated technology, that's going to take more money. That's going to have to go through Congress. Declining audit rates, that's largely a function of not enough revenue agents to conduct a sufficient number of audits. That's going to take more money. So these sort of first four solutions to closing the tax gap, budget shortfalls, lack of information reporting, outdated technology, and declining audit rates, those are largely dependent on what Congress does. And the Biden administration, of course, can't make these things happen right away. Currently, they're trying to get additional funding for the IRS through Congress, and it's caught up in the infrastructure plan. And of course, the debate is ongoing. So maybe they'll get the funds they need. Maybe they will get the new laws and regulations that they want, or they may not. So what can the Biden administration control on its own without necessarily having to go through Congress? The last two bullet point here on this slide, higher income taxpayers with aggressive tax positions. Of course, the Biden administration, IRS can certainly start targeting higher income individuals for their audits. What can the IRS under the Biden administration do about sophisticated tax practitioners? Of course, many of you are familiar with this. The IRS can pursue promoter penalties and can start pursuing those promoter penalties more aggressively. So is the Biden administration doing these things? Well, they have said they're going to do it. Are they being true to their word? What are some of the high priority audit and enforcement issues in the Biden administration? Well, it should come as no surprise that the IRS under the Biden administration is going to start focusing on promoters of sophisticated tax avoidance or evasion schemes. And recently, this April, the IRS created an IRS Office of Promoter Investigations. This was not necessarily new. It wasn't an idea that the Biden administration had first. In 2020, the IRS established a promoter investigations coordinator. However, now the Biden administration has elevated this from a coordinator position to an actual office within the IRS. And they are going to focus a significant amount of efforts on pursuing promoter investigations. And in my former life as a federal prosecutor, I handled many criminal tax cases and represented the United States in pursuing tax evaders from time to time. But I also handled other types of criminal cases as a prosecutor, and I handled a fair amount of drug cases. Well, what could prosecuting drug cases possibly have to do with the IRS Office of Promoter Investigations? Well, in federal criminal drug prosecutions, it almost never happens that cases involving mere possession of a controlled substance get prosecuted. The prosecutorial resources are almost always devoted to those individuals who are selling the controlled substances, selling the drugs, helping make the drugs, things of that nature. And the theory is, if you put the dealers out of business, that will be much more effective than going after individuals who might be using the controlled substances. Well, the same thing sort of applies here. The IRS believes that if they go after the promoters of these various tax avoidance schemes, they will get more bang for their buck as opposed to going after solely the individuals who may have participated in the particular tax avoidance scheme. And there's some logic to that or some reasoning to that. Of course, if you have a promoter who has promoted a particular scheme to hundreds and hundreds of individuals, it makes a lot more sense to try and put that promoter out of business as opposed to using all of your resources to go after each one of the individuals who may have been involved in those tax avoidance schemes. So the IRS under the Biden administration, they've already created this Office of Promoter Investigations. It certainly appears that they're going to devote a lot of effort to going after promoters. And then they talk a little bit in this press announcement about the different types of tax avoidance arrangements that they want to pursue. Of course, they mention abusive syndicated conservation easements, and they also mention abusive micro-captive insurance arrangements. I don't know if the IRS ever met a conservation easement program or a micro-captive insurance program that they did not think was abusive, but they're at least saying they're only going to go after the abusive ones here. And they've appointed Lois Dietrich, a 20-year veteran of the agency, to act as this director of the Office of Promoter Investigations. So that was April 19th of this year. What has this Office of Promoter Investigations been doing so far? In June of this year, Ms. Dietrich, the newly appointed head of the OPI, gave a talk at the NYU School of Tax School, talking about the work she's doing and what they are going to do and how they're going to prioritize audits. And she said some things that are fairly interesting. She listed various targets And then she also, on this slide, according to tax analysts, she talked about going after promoters. Well, that makes sense. If it's the Office of Promoter Investigations, we're going to go after promoters. But then she took it one step further. She said their office will eventually investigate, and this is in the second paragraph here, will eventually investigate all of the enablers of an abusive transaction. Well, what is an enabler? I'm not sure anybody really knows what an enabler is as opposed to a promoter. But then Ms. Dietrich went on to say that whether that is an actuary, an appraiser, a return preparer, or the attorney who drafted a legal opinion, they will all be looked at as to their involvement. And then she goes on to say that if we find evidence that the enablers knowingly pushed false statements as to the federal tax benefits of the transaction, we will pursue any and all applicable compliance paths. Of course, the applicable compliance paths she listed, that's a referral to the IRS Office of Professional Responsibility. So perhaps somebody could be barred before or prohibited from representing clients before the IRS. She also mentioned CI, which of course is the Criminal Investigation Division of the IRS. And then she also mentioned referral to the Justice Department for civil remedies. But this is taking it a step pretty far beyond promoters. A promoter, and we'll look at the definition of that in a few minutes under the relevant statutes, but a promoter is somebody who is generally involved in the sale of a particular scheme. But what is an enabler? What if you're a long-time tax attorney for a particular client, and you have a particular client who learns about some sort of tax savings vehicle, and he or she wants to know more about it. So they gather some literature from the promoter, and then that client comes to you and says, hey, take a look at this. And you take a look at it and you give your client an opinion on this particular tax avoidance transaction or this particular tax savings transaction. And you tell your client, yeah, I think this looks pretty good. Well, you weren't really involved with the promoter. You weren't really involved in the sale, but you certainly gave an opinion to your client about this particular tax savings vehicle. Does that make you an enabler? And are you now an enabler and the IRS is now going to come look at you? So I think it remains to be seen how aggressive the IRS is going to be. It remains to be seen whether they're going to really pursue or look at all of the enablers out there. Of course, it depends on how they define enabler, but certainly this is the new director of the Office of Promoter Investigations casting a very wide net in terms of who they want to perhaps focus on in their enforcement efforts. So more about how the IRS, or more evidence that the IRS is going to be pursuing so-called promoters or perhaps enablers. Of course, many of you are familiar with the list that the IRS publishes every year called the Dirty Dozen list. And these are all of the tax savings or tax avoidance transactions that the IRS feels are the worst of the worst. And they want to advise taxpayers to be careful and not to participate or get entrapped in one of these sort of scams. And this ranges from everything from these fake phone calls that you might get about owing the IRS $5,000 and they want you to wire the money to them immediately, to just a range of sort of scams that the IRS is trying to highlight. Well, for 2021, they included in their Dirty Dozen list just sort of a general catch-all category of promoted abusive arrangements. And again, the IRS is being very broad in how they define who they want to go after. They're broad about how they're defining promoted abusive arrangements. And as we saw earlier, the IRS mentioned conservation easements or syndicated conservation easements and captive insurance arrangements. They're now listing additional ones. They start with syndicated conservation easements, then abusive micro-captive arrangements, Then potentially abusive use of the U.S.-Malta tax treaty. That's a new one to me. I'm not terribly familiar with that. Improper claims of business credits, and then improper monetized installment sales. So again, more evidence that the IRS is going to continue to pursue certain types of arrangements that they feel are abusive, and they're going to not only go after the taxpayer who may have permitted or may have participated in that particular arrangement, but they're going to focus a lot of their efforts on the so-called promoters and perhaps the so-called enablers of those types of transactions. So just to give you an example of what the IRS is doing, this is an excerpt from a letter that one of my clients received. Of course, I've redacted all the identifying information from it. And it's from the Treasury Department, the IRS in Columbia, South Carolina. And it's sort of an audit, the equivalent of an audit opening letter, except it's not just a traditional audit. It's actually a promoter penalty investigation. And they are trying to schedule a time here to meet. They want the individual under investigation to meet with the examiner. And of course, the promoter penalty audit proceeds very similarly to a traditional IRS audit. And the IRS wants voluminous documents. They want documents about all of the various particular clients that may have participated in these transactions, et cetera, et cetera. And so we're starting to see more and more of these promoter penalty type audits as a way, I believe, for the IRS to focus its attention on the tax professionals who were involved in recommending certain transactions that the IRS doesn't like, as opposed to going after the individuals or entities that actually participated in those transactions. And it's a way for the IRS to put the promoters out of business, so to speak.
George, looking at your letter there, you also see on the first line, it's possible that this is a form letter sent to a tax return preparer. Now, in our practice here, we've seen an increasing number of tax return preparers get this type of letter, and we've actually seen a few indictments, and I'm curious whether you in your practice or the audience today has seen any increase in preparer audits or investigations.
Right. And I think there's kind of a fine line between, is somebody just a preparer or are they actually a promoter? I think you could certainly distinguish between the two, but we're certainly seeing many more audits and letters such as this going out to tax professionals as opposed to just typical taxpayers who may have relied on a particular tax professional for their decision to participate in a transaction or who they relied on to prepare their actual return. So yeah, I think sort of traditional tax return preparers are often getting caught up in this sort of promoter penalty investigation as well, or investigations also. So I think it's helpful to talk a little bit about how the Internal Revenue Code defines a promoter, and this might help answer Jeff's question as well. But Section 6700 of the Internal Revenue Code imposes these promoter penalties and imposes penalties for promoting abusive tax shelters. And of course, they provide a definition of who these penalties can be imposed against. And the first section of this statute is very broad. Any person who organizes or assists in the organization of a partnership, an investment plan, or any other plan or arrangement, or anybody who participates directly or indirectly in the sale of any interest in an entity or plan or arrangement referred to in the previous paragraph. So this is very broad language. It's not just a tax accountant who writes an opinion. It's not just the person who actually receives the profits from the sale of the particular tax savings transaction. It's any person who helps or assists in the organization of the entity or the plan or arrangement. And then adding to the definition, somebody who makes or causes another person to make or furnish a statement which they know to be know or have reason to know is false or fraudulent as to a material matter. Well, of course, all of us are going to be very careful, and I don't think any of us here today are going to knowingly be involved in a situation where false or fraudulent material is being relied upon. But the IRS often will take a very aggressive position in terms of what is false or fraudulent, and they will rely very much on this section about the particular individual had reason to know was false or fraudulent. And we're seeing much more aggressive behavior or much more aggressive tactics by the IRS in this particular space. Jeff, we're at 2 o'clock. I know people probably have busy schedules. I'm about halfway or 2/3 of the way through the presentation. Are there any questions? Maybe we could field some questions that might be pending.
George, there is one question on the Q&A line down there. Do you see that? From Matthew?
I don't know if I can access it. Maybe can you read that to us?
Okay, I'll read it to you. Matthew Gree states that we have seen aggressive efforts to pursue the enablers involved with the conservation easements in Georgia. What are your thoughts on the IRS's use of serious criminal charges and not just promoter penalties in these cases?
Yeah, well, that's a great question. And of course, the IRS, the most aggressive tactic they can take is pursuing a criminal case against some folks who might be involved in these transactions. And of course, there have been 2 CPAs here in Atlanta who have pled guilty to criminal charges arising out of conservation easement transactions. And there's another CPA here in the Atlanta area who was indicted recently. I think the IRS, if you look at the criminal cases that they have brought so far and the guilty pleas that they have obtained so far, you're seeing sort of a common element. The criminal charges stem from these conservation easement transactions, but really the heart of these criminal charges are really more traditional criminal conduct as opposed to just participating or recommending a conservation easement. What I've seen in both of the criminal cases that have been brought thus far, the IRS is focusing on backdating of documents. And of course, if somebody needs to invest in an easement in 2020 in order to reduce their 2020 tax liability, but for some reason they don't, and they actually send their money in for the conservation easement in February of 2021, then they shouldn't be able to claim that deduction for 2020. But what is happening, or at least according to these indictments and guilty pleas, is that some folks involved in the easements were actually backdating the documents and allowing individuals to claim deductions in 2020 or the prior year, when in fact they didn't invest until the subsequent year. And so the IRS has focused a lot of its criminal efforts on these backdating, sort of the backdating activity, as opposed to focusing on, what could be, let me state that differently. The IRS has not claimed that the conservation easements themselves are inherently criminal. They are focusing on other criminal conduct, alleged criminal conduct surrounding those conservation easements, and that's how they're pursuing them. And it is a very aggressive position that the IRS is taking, but obviously this is pretty much the IRS's #1 enforcement priority at this point. And it doesn't surprise me that they are using the criminal statutes to pursue some of the individuals involved in the syndicated transactions. So I hope that answers your question. Jeff, I think I'm out of time, so I'll turn it back over to you. So thank you very much.
George, thanks a lot. It was very clear and very impressive. And if you're not paying your taxes, you should be scared. Andy, are you scared?
No, I'm not scared.
That
Not
means
scared.
he's paying his taxes.
I'm paying my taxes. Well, Jeff, does that conclude the presentation for us here?
That does. That's our 2 hours.
Excellent. Well, I want to say thanks to our presenters, George Abney and Professor Brewer. They were both well accomplished tax lawyers, and they brought a lot to the table today, and I appreciate their willingness to do this. And I also want to thank Jeff for his work in putting this event together. I want to thank everyone, Lane Sosby at the bar, who helped put this, is facilitating this event. And a reminder that all of you who participated today, you don't need to do anything else to get your CLE credit. Lane will send that information to the bar. So that should happen from automatically. And again, the tax section is covering the CLE fees on this for everyone who attended. Thank you all for attending. We've had great attendance today. And I, again, want to echo Jeff's comment that I hope next time we do something like this, we're doing it in person. I really would like to see everyone's faces and not just names on a list at the bottom of the Zoom chat. So I look forward to that, as I'm sure you all do also. I want to remind you one more time about our annual meeting on August 9th. I hope you can be there. And again, thanks everyone for joining us. And I hope you have an enjoyable and productive rest of your day. Thanks a lot.
Ladies and gentlemen, this does conclude today's webinar. Thanks for joining and have a great afternoon.